try and understand the prospects of where the Indian economics are headed, and who better than Chetan Ahya, the chief economist and global head of economics at Morgan Stanley, joining in on the show right now. Chetan, hi, good morning. Good to have you on the show after a while. How is it that you would compare the global COVID-linked recession, Chetan, the world has got itself into right now with the previous one, which was a rather, triggered by a global financial crisis, not a scientific or a medical trigger in that sense? How is it that you would analyze and differentiate between what happened in 2008 and what's playing right now in 2020?
So we think that this is a sharper but shorter recession compared to GFC. And there are three reasons why we see it to be a shorter recession than GFC. First is that this is a crisis which did not start out as a financial crisis. The private sector leverage in the U.S. before the crisis was already declining, and the financial system was in a much better shape. The second difference is that we've got an aggressive policy response. So when you think of the G4 central banks and government spending, that has been far more aggressive than what we had seen during GFC. And the third is that we think that the situation will somewhat be in control faster than what the market is right now thinking about. So these are the three reasons why we think it will be a shorter recession than GFC.
Chetan, to counter this impending recession, governments across the world and central banks have actually injected liquidity into the economies, taken steps, lots of announcements. India as well has seen, an economic package to the tune of about 10% of its GDP. How do you see the scale of the stimuluses being announced across the globe and the effectiveness in actually cushioning the blow from COVID-19?
And when you think about the fiscal policy for G4 plus China, we expect the fiscal deficit in 2020 to be at 10.2% of GDP versus 4% in 2019. So there will be close to 6 percentage point of GDP expansion in fiscal deficit for G4 plus China, and the numbers that I gave you are the primary deficit. So this is really the stimulus as it's measured by cyclically adjusted primary fiscal deficit. So this is the real stimulus. So that's quite aggressive. And when you think about the Fed alone, we're expecting the fiscal deficit to expand to 19% of GDP on a headline basis, which would be including all the measures that has been announced so far. And there is a talk that there will be potential an additional $1 trillion of fiscal expansion. So that will take U.S. government's deficit to 24% of GDP. And that compares to 27% that we had seen in 1942 due to World War II. So this is a very aggressive fiscal expansion that the U.S. government is taking up too. So when you think about the policy response in total on central bank side and from the government side, this is totally unprecedented.
So how deep do you think this recession this time could be? I mean, if you are saying that it's going to be a fall, how would you measure the extent of the fall first?
So in terms of the nature of recession, we are expecting global growth to contract by 3.2% of GDP. So in terms of the depth of this recession, we are expecting global GDP to contract by 3.2%. And when you are thinking about the recession per se compared to GFC, what we also look at is the number of quarters it takes for the output levels to get back to where it was before COVID-19 shock hit us. So, for instance, in DMs, we expect the output levels, which if you were to assume was at 100 in December 19 quarter, we expect it to get back to that 100 level only by fourth quarter of 2021. But this would still be shorter recession compared to GFC because in GFC, we took 14 quarters to get back to the same level of output we were before crisis.
So what are the high frequency data points, Chetan, on your radar which will tell you how things are moving?
So right now we are looking at the most important high frequency indicator is the mobility trend. And when you look at the mobility trend, they have started to improve across the world. And our analysis from looking at this mobility trend and other high frequency economic indicators is showing that China bottomed in the month of February, US and Europe bottomed in the month of April, and some of the other EMX China economies we think will bottom out in May. So all in all, by the month of May, we would have seen global economy fully bottoming out and having to show improvement in growth.
Good to have you on the show. Thank you so much for taking the time out and speaking with us and your thoughts about the world economy and how COVID-19 is going to impact it.